one of your businesses, you have over 200,000 customers in over 120 countries around the world at 35 million in revenue. So that sounds like you figured a few things out.
My entire model is based off of my life and business philosophy, which I call whales and minnows. And the idea behind that is quite simple. It's make it free or make it expensive. Show up or don't show up. Do the thing or don't do the thing. The problem that we fall into is that it's just so easy to kind of dip a foot in, in a world where we all have a recording studio in our pockets, where we can spin up a website for free. We can send out an email blast or social media posts for nothing. And it's too easy to do a bad job these days. And so my entire structure is based off of, I'm going to feed the whales. I'm going to sell to the whales. And then I'm going to use the spin-off of those high profit enterprises to feed the minnows, and some of those minnows will eventually grow into whales.
What's up, Jonathan? Good to have you on the show.
Hey, this is exciting. As somebody who read your book before I knew you, this is really exciting, Justin.
Well, I can't wait to chat. By the way, you're supposed to be in town. We're supposed to be recording this live, but I think for both of our schedules, this actually worked out great, where, we can do it remote. And I just find podcasting so much easier to do, remote type of sessions. But YouTube really likes the in-person, both people. It populates better. So I have this, this love-hate relationship with, the coordination of an in-person, but how it performs on YouTube, is always better.
I feel like if it's your full-time thing, in person is better. I popped out to New York City. I'm from Toronto, right? So I popped out to New York City for a day and just basically ran around the city doing live. And I was going to do the same thing in Austin, for 3 days. And then I kind of thought more deeper about it. And I mean, I have a 7-year-old and a 2-year-old and a pregnant wife, and we're living in Mexico in the winters. And I have this book coming out. I have a book that's just come out, and then I'm just about finished the first draft of the next book. And I'm like, let's 80-20 this for a minute.
Yeah, that's the way to do it. And you're at a point in your life where you don't have to be maximizing everything anyway. You've done well for yourself, and we'll get into that here. But
we'll talk about it. Yeah, we'll talk about it.
Yeah, I'm excited to chat, and really, I'm just thrilled to be able to tell your story. You and we met at Mastermind Talks. So
yes,
thanks to Jason Gaynard. We appreciate that connection. And the first, small group that we put together, or that was put together for us, we were in that group together. And by the way, you'll be pleased to know that I'm actually hanging out with Sean on Friday. So the three of us are actually all hanging out this week.
I love it. Sean's such a cool guy. He's nutty in every wonderful way. This dude, somebody who writes that many books, I think has to be a little bit of a nut.
Yeah. So, how many books has he written? This is crazy.
Written or ghostwritten?
Yeah. I mean, it's over 100, I think, right?
Well, but he's got a machine of other writers who work with him.
Yeah.
And so he explained it to me once. He's very, very good at coming up with a theme, coming up with the characters, coming up with the general story structure. And then he basically just has other writers fill in the gaps. And then he just comes up with the next framing or scaffolding. I might have gotten that a little bit long, but that's kind of what it is, which is not uncommon to a lot of the authors that we know. I had somebody on staff for a number of years who wrote a number of Goosebumps of Sweet Valley High books.
Okay.
He also did a lot of the cover stories for GQ and stuff. He was the guy they'd fly out to interview Hugh Jackman. But he told me, he's R.L. Stine literally just sat there and came up with the idea. And then it was just monkeys on typewriters. There was 20 of us who were just basically writing these books constantly, all day, every day. That's how a lot of this stuff
that's awesome
has come to be. So,
well, he's a genius. Sean Platt is who we're talking about, just to make sure we give him a proper shout out.
It's cool. It's cool figuring out what goes on behind the scenes of this stuff. A lot. Yeah.
Well, you've written a ton of books, right? 11 books. Is this your 12th or is this your 11th book?
This is my 12th.
Yeah.
This is the first traditionally published book. All the other ones have been self-published. And, take it with a grain of sand. This is my 12th book. 3 of them were ghostwritten, actually by this guy who did the Goosebumps and the Sweet Valley High. And one of them was a textbook. One of them was a children's book with my wife. But yeah, most of them have been business, nonfiction. Yeah, it's been fun to work with a publisher. A lot of people kind of poo-poo the idea of traditional publishing, particularly if you already have a platform, particularly if you already know and have the contacts to like self-publish well and professionally. I have found the experience to be quite wonderful, start to finish. The product that we've put together with the help of my agent, the publisher and editor and everybody has been so far beyond anything that I've ever been able to do with teams that I've been able to assemble, to the point where I'm actually embarrassed by my previous works because of I look at this one and now this is what I compare everything to, which I think is a good goal to have whenever you take on any project.
That's right. And we all evolve, so it's like what at one point you were proud of, 10 years later, you're embarrassed of because you're like, oh, it's so elementary. My writing style was, so boring or whatever. Yeah. So, I mean, when I just, launched the updated and expanded edition of Lifestyle Investor, I mean, the gap in time there is only, 4 or 5 years. I was
going to ask you, how many years? Yeah.
And I felt the same way. I'm like, ugh, I didn't like the way that sounded or that flowed. And, I should have expanded on this. I mean, it's like I could have rewritten the entire book.
Yeah.
I really could have.
Yeah. I find that particularly the books and the stuff that I've written in the way that I communicated when I was young, I felt like, I don't know, maybe you'll resonate with this. You wrote that book a lot more mature with a lot more life experience than I wrote my first book. I mean, my first book I self-published as a 24-year-old personal trainer.
Wow.
And it was a book of how to be a good personal trainer, right? And so I feel like looking back, I was overcompensating a lot for a lack of confidence, like, who am I to write this book? To the point where, my friends call me John, but my professional name is Jonathan. My real name is Jonathan, but my friends call me John. The reason why Jonathan is on my books is because when I was 24 and I self-published my first book, I wanted it to seem like I was older than I actually was. And I felt like the name Jonathan felt older than the name John. And so now I'm stuck with that name on my books. It's all of these little silly things.
That's really funny. Well, I love learning some of the inside scoop here. You're a prominent figure in the fitness industry, so I like hearing about this. I think your first really big book was Ignite the Fire.
Yep.
Because that one you have over 1,000 reviews on that one, right?
Yeah.
Okay.
Yeah. That one sold over 100,000 copies. Yeah.
Wow. And so was that geared towards trainers or anyone that wanted to be, fitness minded?
Ignite the Fire is a book for personal trainers on how to have a successful career. It was really the first book. I mean, now it seems so obvious to say this, but it was really the first time somebody in the fitness industry came out and said, y'all, I think we got this wrong. I think probably the importance of the quality of the workout that you give to a client pales in comparison to the importance of your ability to get somebody to want to do that program. Like there's a lot of ways that somebody can jump up and down and sit down and stand up and lift something up and put it back down that will get them in good enough shape for their goals.
Yeah.
What actually matters more is that they want to do it and that they do it for long enough that it makes an impact. And so the book was a lot more centered in psychology than it was centered in physiology or biomechanics, which at that point was quite rare. I mean, now it's pretty commonplace in the fitness industry. And then, I mean, I talked about business and how to structure your career and how to, develop yourself personally when you're young in your career, so that you kind of think long term. Like, how do you optimize mentors? How do you optimize learning early on and recognize opportunities for that early on that might actually even involve the trade-off of perhaps a lower salary? How do you optimize for different types of opportunities over the course of your career, and then different income streams, all that kind of stuff.
Well, and you've got a bunch of income streams. We should talk about this. You started several businesses, so you're a founder on many levels. I believe one of your businesses, you have over 200,000 customers in over 120 countries around the world at 35 million in revenue. So That sounds like you figured a few things out. You got into real estate investing early. I mean, let's tackle some of these things. Tell me a little bit about your businesses. And, I think one of them's a software business, right?
I have a software company as well. Yeah. I mean, I operate, my entire model is based off of my life and business philosophy, which I call whales and minnows. The cover of my book, The Obvious Choice, there's a whale, made out of a $100 bill, chasing a bunch of pennies. That's whales and minnows. The last chapter of the book is whales and minnows. And the idea behind that is quite simple. It's make it free or make it expensive. Show up or don't show up. Do the thing or don't do the thing. Mm-hmm. I think a lot of the time, the problem that we fall into is that it's just so easy to kind of dip a foot in, in a world where we all have a recording studio in our pockets on our phones, where we can spin up a website for free. We can send out an email blast or social media posts for nothing and have them access, everybody maybe, but probably not. It's too easy to do a bad job these days.
Yeah.
And as a result, a lot of people do, but it feels like work. It feels like progress. And so my entire structure is based off of, I'm going to feed the whales, I'm going to sell to the whales, and then I'm going to use the spin-off of those high profit enterprises to feed the minnows. And some of those minnows will eventually grow into whales. But other ones won't. And other ones, I can feel good that I'm doing a good job for. So at the lowest level, I've got my books. My books aren't free, but they have zero expectation of service.
Yeah.
And that's the line for me. Nobody buys a book and expects the author to service them in implementing the information in that book. Now, if I did a low-end membership site, for example, there would be an expectation of service.
That's right.
And so I've learned that the hard way. I've had 3 membership sites.
Okay.
Right? 2 6-figure, 1 7-figure membership sites, and I've shut them all down. One was a physical newsletter.
Okay.
That we had, we launched it at $40 a month, and we had 1,516 subscribers on day one, and then we put it up to $60 a month. We ran that for 10 months. And then I had 2 more conventional membership sites, protected information behind a password, that type of thing. I didn't like those because they required too many customers. And there was just a high expectation of service throughout. Whereas books don't have that. So on the low end, I've got, zero expectation of service. And then I have basically coaching programs, right? And I like coaching programs. People, you shouldn't be in a service business. They're not scalable. It's like, they are scalable if you know how to scale a coaching business. I think coaching businesses are one of, if not the best businesses to own, because they kick off a lot of cash up front. You can run them at an extraordinarily high profitability. Like, we run our coaching businesses at a 65% profitability.
Yeah, that's nice.
It's very nice. They kick off a lot of cash up front. But I don't, just my own personality. I'm really, really good at starting things. I'm really, really good at taking things from 0 to 1. I'm not good at running things ongoing. I know this about myself. You would not want me as your coach. I would be a terrible coach. So I own 2 coaching businesses. I have not worked a day actively in either coaching business.
Okay.
They're fantastic businesses, and both coaching businesses are basically people in fitness. I wrote the textbook for online fitness, so I kind of created that industry back in 2012.
Okay.
And so both of those are for people who in person want to transition to online coaching, and then people who are already online coaching and want to kind of scale up their online coaching, right? So it's aspirational. There's 2 levels. What you do to get to 0 to 5, $0 to $10,000 a month is very different than what you do to get from 10 to 100, 200, 250. What you do to get from 250 to $1 million is, very different as well. So
that's right.
You kind of need different programs and different structures within those. So I've got those 2 coaching businesses.
And by the way, did you start those or did you buy those?
No, I started those.
Okay.
Yeah, I started those. I built the model and then put the operator in place. I believe very strongly in insane incentivization structures for key staff. I have figured out over the years, painfully, that one person who is stellar at their job, incentivized properly, is worth 50 to 100 people who are just good to okay at their job.
Yeah.
And so almost all of my expenses, all of my core expenses are directly tied via profit sharing or commission structures to revenue.
Okay.
And that works really well. That's not like a growth oriented strategy. That's a John sleeps better at night optimization strategy. I don't worry about payroll because by definition, if payroll is much higher, that means that we've taken in much more money. And that's very different than how things used to be. So that works out really, really well. And then, I started a software company called Quick Coach. We have 43, 44, 45,000 users or something. And that's kind of my moonshot bet. I knew what I was signing up for there. I knew that the odds that it worked were relatively small. It seems to be working. I recognized an opportunity in my industry on the low end. 92% of personal trainers never have more than 10 clients at any given time.
Wow.
All the software platforms that exist that serve trainers are what SaaS platforms tend to do, which is they go out and they get funding from private equity, VC, whatever, or they build and then they get funding later on or they get bought or whatever. And their goal is to basically invent new features so that their users pay more.
Okay.
And then they charge based off of the amount of users that their customers have on the system. So in this case, it's like, if you're a trainer and you've got less than 2 clients, you're free. If you've got 5 to 10, you're at this price. 20 plus, you're at this price, 50 plus. I decided to enter in the business with a different business model, which is really on the low end, serve the minnows with this scalable solution that by definition is simpler, no integrations, no automations. I wear a Casio watch because it reminds me to solve the problem simply and never touch it again. My software platform is the Bic pen, is the Craigslist, is the Casio watch of the software world. Okay. And the only reason why I was able to do it is because no other platform in my industry has a personal recognizable face or brand behind it. And so I'm able to acquire customers and users in a way that other people aren't. Their user acquisition costs are simply too big to be able to attack this market on the low end where the majority of the customers are. And so, anytime that I'm trying to spin something up, it's like, do I have a really significant competitive advantage moat in this? Well, if I don't, I'm not going to do it. So, the software seems to be working. It's profitable month over month. It's not crazy profitable month over month, but it's profitable month over month. And the nice part about it is that the expenses won't scale.
Right.
Because it's kept simple. So those are the businesses. And then, like any good active business, Justin, I feel like it's silly telling you this because you know this better than I do. The best way to make money is with money.
Oh, yeah.
I mean, my investments make
100%.
way more money than my active businesses do. And it's not even close. I mean, it's to the point now where it's just kind of silly. To the point now where I look at how much money I'm making through my active businesses and I'm not really that motivated to work in them.
That's right.
So
good to have good people then. These comp structures that you were talking about really matter now.
We could talk about the investments. But, I think that that's understated though. And that's why I love the work that you're doing so much is because, really for most of us, I think that the goal of any active business is to make money so that you can make money with your money.
That's right. Well, let's talk about some of your investments. Before we do, can you give us an example? You don't have to give away the exact secret sauce, but are you willing to share an example of what some of the comp structures are or look like or are even approximately like? Because there are probably a lot of people tuning in here that they have acquired a business or they want to acquire a business, but maybe they're unsure how to structure it in a way that they're worried they won't get an operator or the operator won't stick around. And it sounds like you have solved for that because, as I always tell people, if you are incredibly generous on the split, and you got to find the right person for this.
Yes.
So it's got to be the right person first and foremost, right? They need to have a work ethic. They need to be trustworthy. They need to be hungry. there's a certain skill set that you're looking for and a certain avatar you're looking for. But if you are extremely generous with the splits, they will stick around. So I'd love to hear some of what you've done.
Yeah. So there's a couple of different components of it. You can kind of poke at and pull at any of these strings if you want, Justin, but there's kind of three different components of it. And so, you have individual contractors. So like, for example, like my content team around my personal brand, right? So that's one where it's really performance-based incentive. Then you have the most obvious, the most common is anybody associated with sales. So sales team, whether it is sales team on the front end, like DM setting, like that type of thing, or whether it's phone sales team, we have both of those departments. And then operators of the business. And so my philosophy, and there's a lot of people who have different philosophies. I'm not saying that this is right, but my philosophy is I really want ownership. And so I actually still own 100% of all of the businesses that I have. I still have 100% ownership of everything. But in one of the businesses, for example, there's a number of profit shares associated with it. And so, I give away 50% of the profits in that business to a variety of people every quarter that they come in. And so we have a lot of agreements as to what are the expenses of the business. For example, the salary that I take, part of my salary is considered an expense in that business. So one of the hardest things about profit share is you have to be very, very clear and really calculate well what is considered an expense and make sure you're on the same page, because it can get very nuanced and very detailed and you don't want any bad blood. So that just comes out every quarter. Like, if you are operating this company for me, you have $0 of a salary, and you are 100% incentivized with this profit share. The same type of thing with a lot of our salespeople, where they have zero. One of them actually has, again, she has kids. She's the major breadwinner in her family, and so we guarantee her a minimum just because that makes her feel safe.
Yep.
She's always been well above that.
Yeah.
Right? Like, if she would, and we're both on the same page. We're like, if you hit this minimum, you get a warning. If you hit this minimum twice, you get 2 warnings. If you hit this minimum the third time, like, this is not working. But she's guaranteed a minimum. And then it's just, you eat what you kill.
Yep.
It's sales. It's sales. And so it's some combination of how many calls are booked to how many calls are progressed, to the next call, to if they convert to a customer, to if that person renews longer. Our coaches earn a little bit based off of their coaching, but they're actually largely incentivized based off of whether that person stays longer.
Okay.
And so they're incentivized based off of renewals. Like you want to incentivize the behaviors that you want to see in your business.
That's right.
Is that person going to renew? We can get them to sign up. The true measure of any successful business, especially one where, in this high-end coaching business, we're talking $9,000 for 3 months. That person has to get a lot of value over those 3 months to renew at $17,000 a year.
Yep.
And then if that person renews, like we just had somebody renew for the 4th time, for the 4th year. And he's been with us since day one in that business. Like, your coaching team has to provide a lot of value there. So make sure you're incentivizing the right behaviors. And then the final one, this is actually my favorite, because I think what a great incentivization structure does is it self-selects out the wrong type of people.
Yes, totally.
And so what I will often do, for example, the 2 key guys that are on my personal brand content team, one of them is more for written stuff across Twitter. The other one is more for video stuff across YouTube and TikTok and Instagram and stuff. The one across Twitter is on like kind of my book strategy team as well. They are both very much incentivized based off of performance, and they came to me and they said, this is the amount of money that I want to make. And I said, that's great. I want you to make that money too. I want you to make way more than that. But I'm not going to pay you that unless you hit these goals. So what we did together is we set low, medium, high. So for example, on the one of the guys, okay, low, medium, high with this book launch. Number of books sold via pre-launch and first week. Low, medium, high. With a kicker for number of Amazon reviews that we get within the first 5 months.
Okay. That's nice to tie that in. That's really clever.
So, because those are the two most important things, right? Like I want to give my book the best chance of success. If it's as good that I think that it is, it's my responsibility to start a 10-year flywheel at launch. And then, the market will prove that out or not. But I got to give it the opportunity. And so what I basically said to him is, okay, you want to make this amount of money per month. Okay, you want to make whatever it is. I'm trying to use round numbers. These are not the numbers. You want to make $10,000 per month. Okay. I'm going to pay you 4. I'm going to guarantee you 4. And then at launch, if we hit the low goal, I'm going to top you up to the equivalent of if you made $10,000 at launch. So he joined me 4 months ago, right? So, 6 times 4, 6, 12, 18, 24. So I'm going to give you a $24,000 bonus. If we hit the medium goal, I'm going to give you a $35,000 bonus. If we hit the high goal, I'm going to give you a $75,000 bonus. Like insane bonus.
Yeah.
Right, for this guy. Like to the point where you will have actually earned like $18,000, $20,000 a month for the work that we did together. But you know what? You earned it.
That's right.
And then 5 months out, whenever we hit, I think our goal was 1,000 Amazon reviews within the first 5 months. So, whenever we hit 1,000 Amazon reviews, so long as it happens within 5 months, you get an extra $15,000 bonus. The video guy is similar, where we're putting a push into YouTube. Haven't really started yet, but we're putting a push into YouTube beginning in January. And so it's the same type of thing. Low, medium, high. You told me that you want to make X amount of dollars. I'm going to pay you like a third of that, guarantee, because you got to make some money. But then, if you do what you say that you're going to do at the lowest level, you're going to make exactly what you want to make. Via YouTube subscribers. And then, so what we have is YouTube is primary, and then Instagram is second. Okay, so if you hit this low goal on YouTube, then you get whatever you asked for. If you hit this low goal on YouTube and you also hit Instagram, you get this bonus. But if you just hit Instagram and you don't hit YouTube, you don't get anything. And then medium, high, the same type of thing. And we have that at 3 months, 6 months, and 12 months for the first year that we work together. And the nice thing about that is these guys are amped up by this. They're young. They are hungry, man. But I was interviewing podcast production teams. And I offered a deal similar to this to a podcast production team.
They didn't like it.
And they said, this isn't how we work. This is our fee per month.
That's right.
And I said, if you truly believe that you're going to do what you say that you're going to do, I will give you enough to make sure that your team is paid. Basically, your profit, Mr. Owner of this podcast team, is dependent on your success of how good of a job that you can do. And if you do that job, great. If you do a better job, based off of these agreeable deliverables, you're going to make way more like stupid amounts of money. And they said, no, we can't work like that. And I said, great, I'm not working with you.
Yeah. They're probably
out.
Yeah, there are very few people in that industry, I think, that would work on a model like that. So yeah, you're going to get a lot of, self-eject.
You are. And that's what I like about it, though, is I found that you kind of need a proxy, a very quick proxy these days to call out, not saying that this team is necessarily bullshitting me, but it's a very quick proxy to be like, that's a data point that they might not quite believe themselves what they're telling me.
Yeah.
Or they're just not willing to go to bat for me the same way.
Yeah.
Like these guys on my personal brand media team are 19 years old and I think 26 years old. I'm 39. Like they exist in my blind spot. Like right. I don't know what they know. I don't know the people they know. I've never watched a YouTube video start to finish in my life. Like that's a blind spot. You know what I'm saying? That's a blind
spot. Yeah. And they have, they're expert matter experts, right? They're area experts. I mean, they know it inside and out. Being able to say
to them, like, you're 19 years old. I know how much I'm paying you. And by the way, I also have a reasonably good understanding of how to invest money for the long term. And if I'm paying you this money, like, I'm happy to talk to you about this and share resources with you so that, this one job that you're doing with me could actually set yourself up for life.
That's awesome. I love that. You're painting the picture
strong motivator.
Long term. Hey, let's talk about investments, because you made a comment that I loved. You had said, hey, if we are really valuing like what my businesses produce versus what my investments produce, it makes all the sense in the world that I live in the investment space, not in the business space. Now I can tell that you get energy, you like your team, you guys are, totally. You're doing some great things right now, and business is humming, but it takes a really special person to be a great entrepreneur and a great investor. And so I'd love to talk about some of your investments that you've done and the returns you've gotten. I know you've invested in, I think you have 13 different rental properties. And I think even if that were the only thing you've done, that's a big win. But I'd love to hear about some of the wins and even some of the losses.
Those are actually by far the worst investments that we've made. Well, the first one was good. We bought we bought an illegal duplex in a town called Midland, just outside of Toronto, kind of like a cottage town, and we renovated it and turned it into a legal duplex.
Okay.
And then COVID happened and the price jumped up. And we actually, 10 months after we bought and renovated that property, we took 110% of our principal out.
Wow.
And just left it and used that money to renovate our kitchen at home, but also buy 3 more investment properties in Sudbury. So we told the bank that we were going to renovate our kitchen at home. We remortgaged our house. I mean, this was just shit dumb luck, but we actually remortgaged our house at a lower mortgage rate.
Nice.
Took an extra $200,000 out, added that to the money from that one house, and bought 3 more houses in Sudbury. And I think one's a 5 and 2 are 3, two plexes. But in remortgaging our house, in Canada, it's 5-year terms.
Okay.
And so what we actually did is we reset the clock in the end of 2020 at 1.89%.
Ooh, that's nice.
For another 5 years.
Yep. So that's coming up then soon.
So that's coming up the end of next year. Yeah. But I mean, that mortgage rates are not 1.89% anymore, right? And so we reset the clock. You know what? I don't even know. I haven't even looked into it.
Okay.
I don't even know. I know that we are on variable for all the rental properties, and it's cut them pretty thin. They're cash flow positive. That first house we've had to put a little bit more cash into, not a lot, but a little bit more cash into, because when we refinanced it, we just cut it really close. But we've also taken 100% of our principal out, so that's fine. But those have actually been our worst performing investments.
Okay.
As a whole, they're fine to have, but Canada real estate is weird that way. I mean, our house in Toronto, I don't know, we bought it for $1.55 million. It's probably worth about $2.5 million now.
Okay.
These 13 properties together are not worth half that. Probably not even worth a third of that. And so that's just the difference between like Toronto real estate and like maybe Vancouver and like everywhere else in Canada.
Yeah, that's interesting. And by the way, I know I have a lot of Canadian friends that will not invest in Canadian real estate. They will only invest in U.S. real estate.
Interesting.
Like many of them. I mean, enough that it's a pattern.
Huh. Yeah. I mean, if I'm completely honest, the real estate investing was a project that Allison really wanted to take on. This was a number of years ago. It's something that I really wanted to do was build our own family's personal philosophy towards wealth management. Like, how do Allison, my wife, and I think about money?
Yeah.
Are we going to try to optimize wealth? Are we going to try to optimize lifestyle? Where is the line? What's enough? What safety blankets do we want? And so, I talk about it in this book, just the importance of what I call leapfrog learning. Basically, you kind of want to attain a mediocre to low level skill set and a whole bunch of leapfrog complementary skills to your core industry expertise. And the best part about that is with enough focus, you can actually attain probably a good enough knowledge on that thing in about 60 days. And so for me, wealth management was one of those. So Allison and I both took 60 days a number of years ago. And the first thing that I did was I read a book just about money. Like I have a kinesiology degree, like I never studied anything like this in school. So just what does debt mean? Where does money come from? What's monetary policy? Like, what do these terms even mean?
Props to you, man. Most people don't even, if it's not in their lane, they stay away from it. So nice job saying, hey, I know nothing about this. I'm a kinesiology major. I've done well in the fitness industry, but I know nothing about money.
How do we figure this out, right?
Yeah.
So step one was, what are these terms? And then step two was, okay, now we need to learn how to think about money. Because I knew at that point that my goal wasn't to make as much as possible. But then, okay, there's still a wide range. So that's when I came across your book, first off. So I read your book and I'm a reader. Allison is a listener. So Allison listened to a lot of podcasts. I read a ton of books on, trying to gain insight into other people's philosophies in money, particularly people who work in the money industries.
Yep.
What do they do with their own money? There's that stat. I'm going to get the numbers wrong, but it's something like 90% of mutual fund advisors don't invest in their own mutual funds.
Yeah.
Like what they say to do professionally and what they do personally is often quite different because the game that they're playing, their desires, their rewards, their risk tolerances, their patterns in life are different than some of the people that invest with them. Right.
That's right.
It's just important to appreciate that there's good information for others that can be bad advice for you. And so where's that line? And so Allison and I built over the course of that period, basically what I call my 4 buckets of wealth. And it's largely based off of quality of life and also just like safety nets. I don't want to worry. I want to make sure we have enough, but I don't want to worry. And so you've got conventional stocks, real estate, Bitcoin, and then personal brand reputation. And I view personal brand reputation, at least for my career, just as important to invest into.
Yeah, that's smart.
A stock.
Yeah,
right?
Super smart. And
so I started to look at it in those buckets. And it was more, I want to hedge against the inevitable. Like if one of these things gets taken out, I don't know which one of these things is going to win big. But if one of these things get taken out, we're still going to be fine, and therefore we will be able to sleep well at night. Was kind of the thought process.
The wealthiest people in the world, they diversify. They don't have all their eggs in one basket, and they do quite a bit of diversification. Now, I'm curious. You and I were talking off camera, and you did really well with Bitcoin. I'd love to kind of hear the story because you kind of pushed some chips in early on in a way that I think maybe a lot of other people wouldn't do it. I mean, this is before it was really popular, I think, to kind of like be building a treasury in Bitcoin, right?
Yes. Yeah. So I mean, it's funny because I didn't have the language for it back then, but in the end of 2019, all throughout 2020 into 2021, I systematically put 15% of my holding company's investment into Bitcoin. So yes, I guess I created a Bitcoin treasure.
Yeah.
And I just held it. It was just investment. I bought it super low. I bought it as it went up. I bought it as it was coming back down. It just didn't matter. It was kind of the Michael Saylor approach. It was like, I either believe that this thing is going to go really, really high or it's not going to work. And if it's not going to work, I need to only put enough in that if I lose it all, I'm going to be fine. If it does work, it's completely irrelevant what the price is today.
That's right.
And so there's no point in even thinking about whether I bought it at. And so, I started buying at 30,000. I bought all the way up to 65 to 66. Like I put 150 grand in at $66,000 just before it crashed back down to 16.
Yeah.
So that felt horrible, right? But
right.
The way that I was able to mentally get over that and not watch the price every day and not panic sell or anything was, this is the philosophy. This is the approach. And a lot of that came from the anti-fragile approach, Nassim Taleb's work into just understanding asymmetry. There's only been one other case in my life where I've looked at something and I'm like, there just seems like there's something here that's really interesting that I've never really seen before. If this works, this seems to be very, very clear that it is a unbelievable asymmetric bet. Whereas if this works, there's basically no way that this is going to work small.
Yep.
Or it's not going to work at all. And then I looked at Bitcoin and all of the study that I did into money helped out. All of this work that I understood about asymmetry helped out. And what's money if nothing other than a story? Money is something that we all agree has value. It's not backed by anything, whether it's seashells, whether it is, Bitcoin, whether it's dollar bills. The only reason that it has value is because the collective we decide that it has value. And so then you have to appreciate the fact that there is a power in this story, and the more people that buy into the story, by definition, the more power that story has, and the more stable that story becomes. And I was like, there are millions upon millions upon millions of different people scattered around the world that own Bitcoin that have bought into this story. The odds that this can fail are getting smaller by the day.
Agreed.
For no other reason than there are just too many people that agree that this thing has value. And so I was like, okay, I have never seen this combination before in my life, and I have not ever seen it since, where there is this thing that exists, where so many people are already bought into it that it absolutely could go to zero. But the odds are pretty small simply because the story has already grown to be so big.
That's
and
right.
so generally accepted. And if it works, it's going to work big enough that I probably will never have to think about money again.
That's right.
And so, I thought that I was crazy, as I think everybody thought that they were crazy, but I was like, it's too clear cut to me. And so it was like, okay, well, what's, 15%? Let's do 15%. Let's do what everybody says, dollar cost average. But, dollar cost averaging was like $100,000 at a time. It was not small amounts.
Right.
I did a bunch of big buys, and then I just did every single week. I just buy $8,000 or $9,000, just every Friday at noon, $8,000 or $9,000, didn't matter. I held on to it. I sold the first bunch of it. Canada had this income tax raise in the period last year. And so it came out to, it was kind of confusing how they did it, because the Canadian government likes to kind of hide tax raises behind confusing nonsense. But they basically rose taxes on investment assets about 9% on capital gains. And so, sheer dumb shit luck, my advisor also bought a lot of NVIDIA for us at $60 way back in the day.
Nice job.
And so we had, this NVIDIA and this Bitcoin that had gone up so much. And so we sold some of both, realized the gains. I have a huge tax bill this month that I just shifted money around. And then, I don't intend to sell it again.
Yeah.
Not to say that I never will, but it was that philosophy of, it was that approach of, hey, let's build our family's philosophy to what matters. Let's try to recognize these signs. Let's be very, very patient until there's an opportunity to be very, very aggressive, and jump on it.
Yeah, I love it. I'm absolutely in it for the long haul. I think at this point, we've got mass adoption, we've got a pro crypto government.
That's the interesting thing.
This is the wild card, right? So if we do have, if Trump moves forward and does create the, Bitcoin reserve, which he has said that he's going to do. Yeah. Well, now all the other G7 countries have to follow in suit. You're going to see more Fortune 500 companies, having a portion of their treasury in Bitcoin, having some sort of a reserve corporately, and holding it on their balance sheet. And I just think you're going to see this trickle down effect, from sovereign nations to the biggest companies in the world. And some of these biggest companies in the world are, their value is greater than the value of these nations, right? Than the GDP of many of the countries. So like some of these companies are like sovereign nations in terms of control and power and output. So yeah, I'm very bullish.
It would be very interesting to see what happens in the coming year, really.
That's right.
With the Trump government, with the pro crypto government. Whether it happens now, whether it happens later, I think it's going to happen. I mean, if they establish a strategic reserve, Bitcoin is not just going to go up a little bit in price, right? Because the question is like, how much is there actually left over? 21 million is the cap. You've got 1 million in Satoshi's wallet that has never moved. That, by all accounts, will never move. I mean, it's probably lost. Whoever was Satoshi or whatever group has probably passed away.
Yep.
And so, but then you've got all of the people who have just lost theirs.
Yeah, people approximate 4 million, right? 3 to 4 million.
How much is actually left? It's a smaller and smaller number, but I don't know. I mean, going back to like the lifestyle thing, you talked about the real estate, and I talked about how it hasn't performed that well for us. We also own within our portfolio. Now, this is all through my advisor, but we also own reasonably significant holdings in a student housing holding company.
Okay.
And that's performed really, really well. That company actually just got acquired. So there was another 30% bump in that fund.
That's nice.
But that's performed really well. But what I have realized, I guess, is that, you can get exposure to real estate without physically owning the house. We have a JV that handles it, but
most certainly
this company, Align-Vest or whoever that owns hundreds and hundreds and hundreds of student houses is going to be more efficient, is going to have better systems, is going to have economies of scale that we don't have without 13 units across 4 properties.
That's right.
And without the headache and everything. So if I had to do it again, if I'm honest, I would not buy the physical houses. I would buy the holdings in
become an LP,
company.
A limited partner in a syndication or a fund. We do a lot of those. And
do you? Okay.
By the way, there's the sacrifice. So it's not that one's better than the other. You can get a higher return when you own deeded property, but you also have a lot more work, So on the LP side, if there's a GP, a general partner that's running it, and they're actually good at what they do, as an LP, you're going to make less than what you would with deeded property, but you don't have any real responsibilities beyond just vetting the deal at the onset. So a lot to love about that. One more thing I want to talk to you about before we wrap things up here today. You've got a killer life. You've traveled and lived in over 13 countries. And one of the things that I love about you is every year you travel abroad for 4 to 6 months, I believe.
Yeah.
And I'd love to hear, just why you've chosen to do this, and B, like, why this is a priority to you. Because like you, I love to travel. I haven't lived in 13 countries, but I've traveled to probably close to 80, probably over 80 now. And we've done, we've lived abroad for a month or two, but nothing. I mean, you've gone much further than I have on this. And I just love to hear your thoughts, because you've got a pretty epic life from the travels. I mean, in general, but from the travel side of things, it's awesome.
again, there's trade-offs, right? It's what are you optimizing for? The only way to maximize is to minimize. You need to eliminate all of the shit that does not matter to you in order to maximize the very few things that do. And so I think the first step is to really become true to yourself and figure out what really matters to you and how can you optimize every ounce of your day and your investment strategy and your work for that. You know, your question's a good one. Why we start doing something is very different than why we continue doing something. You know, why did I start working out? It's because my dumb adolescent self thought that if I got muscles, then girls would like me more. Why do I keep working out? It's because it's my mental health outlet. It's because I want to beat my kids at sports until I can no longer beat my kids at sports. It's because I don't want to hurt. It's because I have found that exhausting the body is a way to energize the mind. The work that I do, particularly writing, requires me to sit for long periods of time. Sitting and thinking for long periods of time is energetically and physically very, very taxing. You have to be fit. I want to be able to write books and to do this creative work for a very long time. The only way to do that is to keep my body strong. And so why I started doing the thing is very different than why I continue to do the thing. You know, why do people start traveling? It's because they want to see the world. Why do they continue traveling? It's because of what the world teaches them about themselves. And so the real reason now that I pick up and leave every year, I call it the 8-4 rule. And it's because I have realized that for me, seasonality in my life is very important to maintain. I get burned out if I live one way for too long, no matter how good that way of living is. And so in the period where I'm in Mexico, you know, like right now, I'm in Mexico, for example. In the period that I'm here, I'm in Mexico for 4.5 months. It's very much optimized towards creative work, family, and fitness. I am not pushing forward on, I call it work or business at all. And it's a chill lifestyle. You know what I'm saying? Like, people here work to live. They don't live to work. The energy is much more laid back. People are not on time when they do stuff. They sit around for a lot longer. They drink juices, you know, which is great. I love that until I don't. And then I need to get the hell out. And then in Toronto, it's a much more frenetic, fervent energy. People there are trying to get ahead. Everybody's on time. It's all networking. It's push, 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 push. And I love that energy until I don't. And then I need to get the hell out. But what I've noticed is that these stops and starts naturally fill my cup in different ways and allow me to be excited and energized for the period that I'm in, because I know that there's an end, and then get excited and energized for the next period. And I have found that it has been very, very key to avoiding burnout, or what I call bore out, over the course of my life.
I love that.
The other thing that it's done, and here's the coolest thing, here's the thing that I only really started to realize the last couple of years, is that what I actually do is I clear my schedule. I clear my calendar. I wipe everything off whenever I get to a new place. So a minimum of twice a year, every single year, for the last 13 years, I have wiped my calendar clean.
Wow.
And then I've built it anew from first principles, from priorities, from big rocks.
Which
and I've
change over
reassessed
time,
my
too.
priorities.
That's right.
Which change and iterate. You know, humans abhor a vacuum. We naturally add, but very rarely subtract. It's very nice to be able to say that when you agree to do something, you're going to subtract something off of your schedule. How often do you really do that? How effectively do you really do that?
I think it's rare. It's rare for me.
It's hard.
I have to be very intentional to do it. And actually, you know, I'm proud of myself because this year I said, I want to add some new masterminds. And by the way, Mastermind Talks being one of them. But I said, there's no way, because I was at 14 that I was actively involved in. I don't go to everything. I just pick and choose. And you know, all I need is one good event and I can get massive value. Right. And I live in the world of like one mindset shift, one connection, one strategy can more than cover the mastermind fees or dues, right?
God. One connection.
Totally.
Yeah. Oh,
yeah.
God. Yeah.
And
yeah,
so
yeah,
for
yeah.
me this year, though, I added two masterminds, Mastermind Talks being one of them.
Yeah.
And so I actually did subtract 2 masterminds. So I did, kind of pull out of a couple.
So you did do that. So I can't do that naturally. And it really hit me when we bought a house, because for a number of years, for the first 6 or 7 years that we did this, we call it 8-4 lifestyle, I owned a backpack and 3 t-shirts. I mean, really, that's what we owned. I rented a car and I rented a furnished condo when we got back in Toronto. And when we left, we gave back the keys to both. We put our backpacks on our back and we set off. When we bought our house in Toronto, I set my backpack down in the corner of the big walk-in closet. I hung my 3 t-shirts and I said to Allison, I guess we need to buy a fork. We owned nothing.
Wow.
You know how much stuff is in that house now?
Wow.
It's amazing how much you fill space when you have space.
That's right.
And how little you think about that space. And so what this lifestyle has done, and you don't need to travel. You don't need to pick up and leave, where you live, twice a year. I won't stop you. But you don't need to do that. But this practice of wipe my calendar clean, reassess my priorities, and enter back into my calendar a reprioritized version of it based off of what is my focus right now. For example, right now, my focus is books. Right now, my focus is my career in authorship, which is my next phase of my life. My best hours of the day, of the week, have to be dedicated towards authorship, has to be dedicated to your priority. And so, that gets put in first.
That's right.
And everything
That's
else
good.
gets slotted around the edges.
That's good.
And if that means that there are things that I don't do or things that I don't do as well, so be it.
I think
so
that's a valuable takeaway, a valuable lesson. I love it. Where can we learn more about you, and where can we find your new book?
I'll answer your question in one go. The book is called The Obvious Choice. It's timeless lessons on success, profit, finding your way. It is for anybody who owns a business. It's for any marketer, salesperson who works within an existing organization. And it's published by HarperCollins. So you can get it anywhere. It's Kindle, audio, hardcover, wherever you like books. Buy the book. I learned a long time ago that books are the best value. I mean, you can see behind you, Justin. You got 100 books behind you, right?
I love it. And I actually read mine. So the ones on this shelf, I've read. If they're not on this shelf, I haven't read them yet.
You want to know something? I wasn't going to talk about this in my little shtick, but you want to know something that I've noticed?
What?
I decided years ago that anytime any book sounds remotely interesting, I knee-jerk buy it. To the point where when I had an assistant, I kept a note on my phone, like an Apple Notes. Anytime I heard about any book, I wrote it in the note. And then my assistant just got the note once a month and just blindly ordered every single book to my house.
That's awesome.
And many of those books I have never read, and I might not ever read. But you wonder what the coolest part about it is that I noticed is that those books are on my shelf. I walk by them. I see the spine of the book. And in looking at the spine of the book, sometimes I'm actually reminded of the podcast conversation that I heard, where I heard the person that I heard about the book, or I remember the Facebook post or whatever it was. And I remember the lesson or the thing that book was going to remind me of. And that actually provides me just that, without ever even cracking open the spine of the book, enough value to have more than paid for the book multiple times.
I love it.
I was reflecting on that a little while ago, which is cool. Anyway, the book, buy it. I hope you love it. I'm on Instagram. I'm on Twitter at It's Coach Goodman. Send me a message anytime. Happy to chat. Share this episode there. Tag me. I'll say hi. I'll say thank you. But the other thing that I'll say is, after you buy the book, if you don't love the book and you want your money back, just send me a message and I'll give you back 100% of your money.
Love it. That's awesome. Money back guarantee and all.
There you go.
And I'm just going to say, if you love the book, or if you think it's just solid, either way, give a good positive review.
That Amazon
helps,
reviews.
That helps authors big time. Well, John, this was awesome. Thanks so much for your time today and for sharing. And I love ending every podcast episode we do with a question that I ask our audience. So what's one step that you can take today to move towards financial freedom and living a life that's on your terms? It's a life by design, not a life by default. And I really challenge everyone to pick something that John taught you today that you learned and implement it ASAP. Thanks so much, and we'll catch you next week.
Appreciate you, Justin.